Hi everyone, and thanks for tuning in to Budget Investing. Today I'm going to go over how to make more money by avoiding certain dividend investing traps, as well as I want to give you a quick update on what is going on with my portfolio tracker here, as it looks very different in comparison to what everyone has seen previously. So let's dive into it. First thing being first, I want to show you what my portfolio looks like now, as other than just the color scheme being a little bit different, I have made some large changes to what I'm tracking and how I'm doing my tracking and the layout of this. So obviously I'll start at the big change on the page here, being this chart that you're looking at. Now I use this chart to make sure that I know where all of my portfolio is sitting in terms of its growth rate and the dividend piece, as that's really the main focus of my portfolio. So I want to make sure that I don't have too many companies that are growing slowly. So that's this low growth section, which is only 4.5% of my total portfolio. I want to make sure that my medium growth companies, that's anything over 6% but less than 10%. I want to have a good chunk of my portfolio being there, which as you can see is 44.6%. And high growth, I want to be as much as I possibly can without being too crazy and putting myself at risk of having those dividends being shrinking. So it's about 50% of my portfolio, which I feel is a very manageable amount and will keep me in a strong position. Now kind of zooming back out and looking at the rest of my portfolio here, as you can see that things haven't really changed that much. It's all pretty much the same information that you would have seen previously, but I've just kind of rearranged it a little bit and kind of spread things out a bit more, as I found with everything so squished down, the important pieces that I wanted to be looking at were kind of hidden. Okay, so trap number one that I want to go over with you is investing into companies that have a really high yield. I know it's super tempting to purchase a company that could have an 8, 9, 10% yield, but it is a serious trap for you to, in the long run, lose all of your money, if not a huge chunk of it. You might gain a bunch of dividends in the short term, or one or two payouts, but eventually that money is going to dry up and disappear. So a perfect example of a dividend trap with a super high yield would be New Star Energy. Now, as you can see that their dividend yield is around 10.5%, and with that price being $15 per share, that means you're going to get about $1.50 per share that you get over the course of a year in dividends, which sounds really good for such a small investment. But as you can see just on the 5 years alone, that they're more or less just kind of flat, other than just going down. They've gone down 67% in 5 years. There's really not a lot of upwards movement in their stock. If we just kind of take out the last couple of big drops, they're still down another 16%. They've kind of just been going lateral and downwards. So why is that? The next thing that makes me really start to question how this company is doing and if they're going to be able to continue doing well is looking at that dividend payout history. As you can see, it was 40 cents the last couple of times, but before that it was 60 cents. And then before that it was $1.09. And that just keeps going back, and you're like, well, it's just going down and down and down. So something's not adding up. I'm actually getting less money the longer I hold this company, which is the exact opposite of what you want to be doing when you're on a budget. You want your money to be growing, not shrinking. And finally, I want to point out this payout ratio that I have highlighted here. Is you can see that, it was around 327% of their cash flow. It went down to about 183. And all of a sudden the reporting amount is kind of just not available, and now it's up to almost 800% of their cash flow is being paid out in a dividend. So that's not sustainable, and this company is going to continue going down in their stock price if they are going to keep paying that crazy high dividend, or they're going to have to severely cut that dividend. So this company is clearly not set up to maintain that, and they don't have any capital to continue to grow their company and grow their profits. So in the long run, like I said before, they're going to stay flat or they're going to continue going down, and you're just going to keep losing money in this in the long run. Now, dividend investing trap number 2 is holding too many stocks. At the end of the day, you want to be able to know what your money's doing, and if you can't keep up with everything that's going on, that's too many stocks for you. So an excessive number of individual stock positions can lead to an enormous amount of required due diligence, as that's kind of what I already said. You don't want to have to constantly be reading up on what's going on in the world and what's going on with every stock and their share price and their earnings. It's so much work, and you don't want to have to be able to do that for 50 or 60 different stocks. It's just not going to be maintainable. You're going to burn yourself out, and you're going to end up just either losing a bunch of money or just quitting altogether. So a general rule of thumb for you to follow would be around that 20 to 30 different companies. It gives you a lot of exposure to a lot of different industries and sectors, and it should be hopefully something that you can keep up with, as it'll only take 1 or 2 hours here and there to really stay in the know-how of what's going on. Now, dividend investing trap number 3 is buying and selling shares just for the dividend. Now, I know in theory that sounds like a great way on how to get a whole bunch of free, easy monies. You know, you buy it on Monday when they have their ex-dividend date, and in a couple of weeks you get $5 put into your account, and then obviously you would have already sold by then, and you just keep bouncing that money around. But you need to remember that that could cost you money if there's transaction fees, as well as on average, when you buy a company and they pay you 50 cents per share, their share price typically drops 50 cents, if not even more, as people are moving their money around. We'll look at New Star Energy again, and we'll see that their latest dividend was paid out on February 14th, and immediately the next couple of days, you just saw their price just absolutely rocket down another $1.47, and they didn't even pay that much for a dividend. So you would have lost a whole bunch of money just right there, which is obviously not great. So, okay, maybe it went down after they declared the dividend. So February 2nd is when you would have had to hold it. So cool, it goes up that next day, up 38 cents, which is great if you're able to sell out on February 4th. But if you didn't, it dropped down. And if you would have continued waiting until the dividend date, then, oh, you're already out $1.16. So it's just not a great opportunity. You can't predict the market, and you're going to set yourself up to fail and lose all of your money. Now, dividend investing trap number 4 is fairly simple in terms of people just don't look at a company's track record. You don't know what this company's done historically. You don't know what they will hopefully be doing in the future, as obviously their history is a great indicator of what's going to happen in the future, but it's not a perfect science. But you need to do your research. What is this company like? Where are they heading? What are you going to do with that knowledge? So let's take a really high-level look at Microsoft. Over 10 years, they've gone up 802%, and they've been increasing their dividend for 18 years. So that's a great track record just all on its own. Yes, there's ups and downs along the way, but they're positioning themselves to be a leader in their field and to continue to give you more money. Again, if we look at Microsoft's dividend history, you can see that it's consistently going up. There's no huge ups, there's no huge downs. It's just consistent, but it's always growing. Almost year after year, they give you a slight raise of, whatever percentage that is on that particular year, but it's still more money just for holding on to this company. And again, for due diligence, the last thing that I'm going to look at for Microsoft is that revenue. And you can see that year after year after year, it just keeps going up, and they're projecting another large increase just this year alone. So just really doing that due diligence, understanding what you're actually buying, it's going to make a world of a difference, and it's going to set you up to continue making money, and you're not going to have to stress out about it every day when you go to bed. So in summary, we want to avoid chasing high yields. We don't want to over diversify our portfolios, and we don't want to just buy companies for their dividend and then sell out and chase new companies. And we want to make sure that we're looking at the track record of companies and really making sure that we're doing our due diligence, as especially now the economy is so crazy, it's up and down, and just no one can really predict what's going on. So we want to make sure we're protecting ourselves and making more money in the meantime with our dividends. So if you enjoyed today's video, please make sure you do like and subscribe, and maybe leave a comment. Let me know if there's anything you'd like to see in the future. Otherwise, thank you so much for watching, and I'll see you in the next episode.